All right, so let's say we're working with a shareholder that is selling. One of the things that the shareholder has to look at is what type of sale are they doing? If they're selling to the outsider and they're going to buy the whole company in one fell swoop, and that company is buying stock, you'll have a capital gain, which is the sale price minus your basis. And then you'll have a tax, and you'll pay that tax all in 1 year, and it's over with. If you sell the stock on an installment sale, like I said before, you'll pay ordinary income tax on the interest and capital gain tax on the principal that you're receiving. And that's if you sell the stock. Now, I'm not a tax accountant and I'm not an attorney, so I'm going to just really do this at a high level. If you sell assets as opposed to stock, there's some big challenges there. A buyer wants to buy assets because once they buy those assets, even though you've depreciated them, they can depreciate them again. So from a tax standpoint, that really helps the buyer. But when it comes to the seller, if you have accumulated depreciation on your financial statement, you have to recapture it all. And so the seller can get just killed by huge taxes if they sell the company that way. Now, a lot of times when Generation 2 are buying from Generation 1, they want to set up a new corporation. They want to buy assets and be able to depreciate them. A lot of times people do that too for liability protection. The new company doesn't have to pick up the liabilities of the company they just bought. So that's something that you have to kind of work out with the accountants and the attorneys to decide what's going to be the best strategy there. But all of this needs to be modeled into spreadsheets so you can kind of see the before and after what this is going to look like. Now, let's say that we start working with the seller and we know what the valuation is. And the valuation is adequate to provide cash flow during the term of the loan. But once that loan payment is off, once it's done, they're going to have a big problem. What we try to do is to come up with a financial model for them that'll help them out. So let's say, for example, you got a good bag of money right now that it's investments, maybe it's 401k money, pension money, maybe it's investments at a brokerage account. And you know that for like 10 years, you're going to be getting income from the buyout. And frankly, you can live on that buyout money, but at the end of 10 years, it's gone. What we try to do is to guide the owners that are selling to develop an investment plan so that once these buyout payments stop, the investment accounts can carry on and provide the wealth that they need to survive. You'd be amazed at how many times we get into this. And the seller is used to getting dividends and salaries out of the business and their lifestyle. They've just gotten comfortable with it. If they sell the company, they're able to continue on with that lifestyle for 10 years. It's different income, but they've got it. But they have a huge cliff at year 11. What's really important is to model out what do you do with the money that you have today so that you can invest it sufficiently so that from year 11 plus, you're taken care of with the money that you've set aside. You know, you got to figure out how much of it do you need to keep invested, how much of it can be spent. You obviously don't want to get into your 80s before you start spending money on stuff that's fun. But if you're 65 or so or 70 and you sell, you want to be able to use this money to play. But it gets back to what does your lifestyle look like? And let's say, for example, we get in a situation where the valuation just is not matching up with the income needs of the person that's selling, a lot of times we can extend the buyout. We can raise the price of the shares if it's family members that are buying out other family members. You can raise the price and you can extend the installment payments from 10 years to 15 years or something like that. It's a real balancing act to come up with the strategy that you know is going to meet the needs of the seller versus the cash flow requirements of the buyer.